the math that a lot of these wellness vendors will use, or maybe even your broker has shown it to you, make a lot of bad assumptions, in my opinion. They're going to talk about engagement and how healthy they're going to get your employee base, and they're going to generate some sort of fuzzy ROI. And often when I look at the math, the ROI doesn't add up. What you're going to spend versus what you're going to get, because the people who are going to participate in wellness, the vast majority of them are already doing it, and you're not having to pay for it. And then the people that you really need to be, to engage your riskiest population are typically the hardest ones, one, to get engagement, but two, to enact change. Welcome to the Benefits Insider. Costs continue to rise. I'm going to peel that veil back. I'm going to share with you secrets that the industry doesn't want you to know. Today, I want to talk about two topics that have come up recently over the last several weeks in my journey working with employers. The first one being, should my company offer a corporate wellness plan? The short answer is surprisingly no. And I say surprisingly because I'm, personally interested in wellness, but I don't think most companies should be doing it. I'm going to explain to you why, what you should be doing instead, and how to implement it into your business. And then the second topic I want to make sure we cover is the impact that addressing rising health insurance costs can have for a mid-sized business. And I'm talking about increases in profitability and additional increases in valuation to the business. So just jumping right in, let's start with, I'm going to start with the margin, the impact of margins. I recently picked up a new client, and this is a larger one for us, but the math and the percentage will still apply for all of us. They spend about $12 million a year on health insurance, healthcare, their partially self-funded plan. And when we started looking at their claims data, one of the things that we're known for is helping reduce the cost of particular claims. And those dollars can then be saved by the insurance plan, which for most of our clients is them. And so as we did an analysis for this particular client of that $12 million they were spending annually on healthcare, it looked like we could capture about $2 million in savings for a number of healthcare procedures, whether it's oncology, members that have cancer. Usually that's very catastrophic for both the healthcare buying or for the health insurance plan, but it's also catastrophic financially for the members. And so those are easy for us to redirect and reduce the cost. But then also other things like orthopedic surgeries and outpatient surgeries. But as we looked at the universe of the data for this group, there was about $2 million in claim savings that would be able to generate. I don't think we're going to capture all of it, but using a safe assumption, let's say we can capture half of it. So that would generate about $1 million savings to this group. And I learned to ask this question because when I was early in my consulting career, I remember meeting with a CFO of a really big company and telling him, look, I'm able to save you $500,000 on this. And that CFO looked across the table at me and he leaned forward and he said, that's not even a rounding error in my income statement. And it baffled me for a second. I was like, wow. I mean, it's a $2 billion company. $500,000 doesn't really move the needle for them. So I started asking the question of business owners and CFOs, how impactful is this particular number to your organization? And so for this particular group, the owner of the company said to me, $1 million is super impactful to us because, and they're in an industry that's heavily regulated by the government, and they run on very, very razor thin margins. He said low single digit margins is typically what they're making at the end of the day. It's a volume play, and they're large. And so the numbers are big. So $1 million, just to put this in perspective, he said to me, for me to generate an additional $1 million of profit in my organization, I've got to have an additional $25 million in revenue just based on their cost structure. That's super impactful to us because I don't have the ability to raise prices. The government sets my pricing. And so I don't have that ability to go back to customers and raise price. So this is going to be the equivalent of me generating an additional $25 million of revenue in my company. That's super impactful to our bottom line. And so it really hit home to me. I wanted to share that with you, but specifically because my goal in this podcast is to share with you actionable insights that you can take and implement into your business to drive profitability and value and help your employees. So I want to share specifically what we're doing for this is one of the strategies that we're using for this particular employer. I mentioned oncology. I mentioned orthopedic surgeries. I didn't mention this, but we'll mention it now, high-cost specialty medications. There's a number of things that we can go in and directly impact the cost of for an employer and the employees without really impacting the quality of the benefits. In many cases, we're actually enhancing those. So this particular employer, they're self-funded. They use a large national PPO network. I don't want to say the name of it, but it's one of the big four networks that we've all heard of: Blue, United, Cigna, or Aetna. And we're keeping that same administrator. We're keeping everything the same. So when we meet with the employees in a couple of weeks to explain their benefits, we're going to explain nothing is changing with your benefits. You get the same network, the same plans, the same everything you've come to know and love from your employer. But we're adding a whole bunch of additional resources to help you manage the cost of your personal health insurance. And one in specifically I want to talk about is we're using some direct contracts that we use for oncology services and orthopedic care, imaging, those sorts of things. And the way this typically works is you think about a big national PPO network. Think about the one you've got. Let's just use the one in your head that you use today, whether it's Blue or United or Cigna, right? When your members go in to have a surgery or to get cancer treatment or anything, name the healthcare service, typically the insurance company is paying 3 to 5 times a fair reimbursement rate for that procedure. So oftentimes what will come in is we'll add an additional program that gets the best pricing with the best quality providers, but it's a fraction of the cost. So I'll use an example for oncology. They've got a number of people undergoing cancer treatment. They're going in for regular cancer infusions that might be anywhere between $35,000 and $45,000 per treatment, and I can get the same one for less than $20,000. Same exact medication. Oftentimes the site of care is more convenient. A lot of times we could do it in home. So it's more convenient for members. I'm looking at their geography. They've got people that are driving 30, 40 miles to go get treatment in a major city when we can actually send somebody to their house for a fraction of the cost. It's more convenient to the member. They have to take less time off of work. The company is saving a boatload of money. It's probably upwards of $200,000 to $300,000 per patient per year. And again, this is a self-funded employer, partially self-funded. That's dollar for dollar savings back to them in their pocket. And so that's one example. The other is there was a number of orthopedic surgeries. So think about knee surgeries, back surgeries, shoulder surgeries. Oftentimes we can source those anywhere between 50 to 75% less than what a traditional insurance PPO network would pay. For instance, in this particular claims example, we saw a back procedure that was over $150,000, and we can source that procedure less than $40,000 all day long. So the savings are not always that dramatic. There were some in that analysis that we did that weren't as impactful. And granted, this is looking back over the last year, and past performance is not always indicative of future results, right? That's the saying we've always heard. And that is true. But here's the thing. In this industry, there is a predominance, and it's known that musculoskeletal is an issue because of some of the physically intensive nature of the job. And cancer is relevant for just about any group. It's non-discriminatory. It hits everybody. And so those are things that we think will continue to happen in the future. And if they do, we now have a way to address that cost. So essentially what we're doing is we're taking these direct contracts and we're offering them in addition to their normal PPO benefit they're used to getting. So really the message to employees is your employer is taking great steps to help you in your healthcare, in your benefits, and we're going to offer you the same benefits that you're used to getting, but now we're offering these additional resources to help you in your time of need. And what ends up happening is the employee, they get access to all of these healthcare services at no out-of-pocket cost. Because the savings is so dramatic, take the cancer infusion, right? If there's $20,000 to $25,000 of savings per treatment, we now have enough money in savings to waive the employee cost. That's the incentive to get them to engage and want to engage in lowering the cost because it impacts them. What's in it for me? It's that old adage, right? So let's incentivize them to help become part of the solution. We help the member get comfortable from a financial savings standpoint, and we explain to them the quality. We share all that data with them. They now save, the employer saves, and actually the providers are saving, and they're happy. It's a win-win-win because they want the patient volumes. So it's really creating a system where you're stripping out all of these conflicts, stripping out any sort of opaqueness in the process and how people get paid, and providing a better benefit, better financial result to the company. So that just gives you an idea of one of the things that you should be looking to do as an employer, because we know based on data that the insurance companies are typically overpaying for healthcare when we can get it at a much lower price. And from a perceived benefit to the employees, you're going to look like a hero. You're helping them get something that they can't. And the reason why I always talk about this too is because if you think about healthcare and health insurance, it's the largest industry in America. And by some accounts, it's over $20 trillion of our national GDP. And when I think about that just on an individual level, right? Think about your company. It's probably one of the more expensive things that you buy, and the cost seems to go up every single year. And we oftentimes don't have much control over it. But when you think about it from your employee's perspective, it's also one of the most expensive things that they buy. And that's just for the insurance. When they get sick and need health care and they're going into a hospital, they're having a surgery, they're taking an expensive medication, it's super expensive for them. Think about your average employee. Maybe your average employee makes $70,000 or $75,000 a year, but they're paying $18,000 a year for insurance premiums to cover their family. That's almost 25% of their pay. And then when they get sick or they need something big from their health insurance, they have to pay the first $3,000 to $5,000. It's 20 some odd $1,000 of their, I mean, it's almost a third of their paycheck. And for most families, that's not affordable. And so this solves the issue for both the company and the employee. So I'd encourage you to investigate some of those things. Ask your advisor, what sort of programming you can add on top of or in addition to your current program at your renewal. We think it's low-hanging fruit. So moving on, going back into wellness. This, corporate wellness plans have been around for a very long time. I've been in the industry over a decade and started working with wellness plans. As soon as I got into the business, we've done everything from very basic to think of the most robust plans that you can imagine offering with wellness incentives and challenges and dollar rewards and all sorts of things. And I'm going to sum up my answer on should you be offering these just based on my experience over the last 10 years. And the answer is, for most companies, if your goal is to lower the cost of your health insurance, the answer is emphatically no. And I know that's not going to be popular with a lot of people. It might be controversial, but I'm going to explain to you why that is, what you should be doing, and actually how to implement it into your business to make an actual impact. So the pitch for corporate wellness plans is, we're going to get your employees healthy, and healthier employees use less healthcare services. And when you use less healthcare services, your insurance premiums can be reduced. And while that logic seems to make sense, it's not actually what happens. So there's two things that I have seen with employers over the last decade, having worked with some of the most robust wellness plans that are out there. The first, it's hard to be healthy and to get healthy when you want to. It's even harder when your employer is trying to mandate it as part of your benefits program. So think about all the people at the beginning of, at the end of a year or the beginning of a new year with all the New Year's resolutions. I'm going to lose 15 pounds and I'm going to get in the best shape of my life and I'm going to be healthy, right? 90 days later, nobody's doing it. It's because it's hard. And it's even harder when your company's trying to mandate it. And so I'm going to give you two examples here. This is what I see. You probably see this inside of your own company. I'm going to call them Marathon Mike and Big John. So Marathon Mike, healthy guy. He eats well. He works out a lot. Maybe even runs marathons for real. And that guy's going to be healthy and participate in wellness, whether you mandate it or not. He's already doing it on his own. I think about Big John, and think of an industry example here. Maybe you're in oil and gas, and he's he's working out on a rig, or he's driving a truck, sits behind the wheel of a truck most of the day, or he's out on the shop floor, in a manufacturing setting. Big John, he loves to drink a 6-pack of Bud Light on Friday. Well, he can't drink Bud Light anymore. He drinks a 6-pack of Miller Lite every weekend, right? Every Friday and Saturday night, eats chicken fried steaks, and he maybe smokes a pack or two a day, right? Big John is fine with that. He's not one to go run marathons and take step challenges and do much of anything as far as wellness goes. And so that's usually the first problem that we see, is that you've already got people participating in wellness, and you got people that are not going to do it and don't want to do it anyways. So the reason why it's important to understand that is because the math that a lot of these wellness vendors will use, or maybe even your broker has shown it to you, make a lot of bad assumptions, in my opinion. They're going to talk about engagement and how healthy they're going to get your employee base, and they're going to generate some sort of fuzzy ROI. And often when I look at the math, the ROI doesn't add up. What you're going to spend versus what you're going to get, because the people who are going to participate in wellness, the vast majority of them are already doing it, and you're not having to pay for it. And then the people that you really need to be, to engage your riskiest population are typically the hardest ones, one, to get engagement, but two, to enact change. And so the second thing I think is important for most employers to look at is, what's your turnover? And I've had employers, maybe they've got 10, 20. I've had one that's told me they have 50%, that was asking about wellness plans. They said last week they've got 50% turnover. They're in an industry, a high turnover industry, a lot of sales, a lot of turnover. So my question back to that CFO was, wait a minute, you're going to spend $50,000 or maybe it's $100,000 and your employees are going to leave you in a year, maybe two? That doesn't make a whole lot of sense. How long does it take to get somebody healthy? How long does it take to get an actual financial return out of this? And then they're just going to leave? That doesn't make sense. So for those two reasons, if you're offering or you're wanting to offer a wellness plan for the intent of lowering your health claims to lower your insurance costs, I don't think it works in that scenario. Now, for those employers, and we have a couple of clients that are like this, they want to offer a corporate wellness plan because it's part of their culture. They want to use it as a way to build up this culture internally of wellness and support, and there's team building that's associated with it. If that's your MO, like, I think that might actually be something worth investigating. But if it's strictly an ROI on health insurance, I don't think it works. So what should you be doing? And this is where there's a little bit of controversy, but I'm going to explain to you what we do and what we advise most of our employers to do as a starting point. So going back to Marathon Mike and Big John. Big John probably hasn't been to the doctor in 1 to 3, maybe even 5 years. He's not seeing anybody. And Big John is the riskier, he represents the riskier part of your group, your population that you're insuring. Marathon Mike isn't as risky from a health risk perspective. And so when I look at data of employers, I always like to see how many members or what percentage of the population hasn't been to see a doctor in 1, 3, or even 5 years. And surprisingly, even though it's covered by insurance, there's no out-of-pocket costs. People don't go to the doctor to get a screening. And so what that tells me is we got a number of Big Johns that are running around inside of our organization today on our health insurance plan that haven't seen a doctor, that have poor health habits, probably a number of health conditions that are undiagnosed. Most common, pre-diabetic or even diabetic, hypertensive, high cholesterol, maybe some other chronic disease that hasn't manifested it to a point where he's going to go in and get seen. And usually the first acute incident sometimes is hospitalization. It becomes a catastrophic claim. So why don't we head that off at the pass and take a more proactive approach? That's what most of our clients want to do. So instead of spending this money on corporate wellness plans, what if we took some of that money and we incentivize employees to go get a preventative screening? We want to make sure that they're getting checked for these chronic conditions that can easily be treated with a $4 generic drug, or even most of our health insurance plans offer these medications for free, no cost to the member. So really it's not like we're asking people to do a lot, but the impact can be profound if you're able to catch a number of these underlying disease states that are unknown. We find out what is the real risk of your population, and we can design benefit programs to address those. And so when I think about how to actually implement this, there's two different ways you can start. The first is I call it the carrot or the stick approach. The carrot approach that some of our employees take, and this is based on your culture, they'll either offer a cash incentive, they'll offer gift cards, or they'll offer a reduction in your premium if you're compliant with going and doing one of two things: going in and getting a preventative screening and doing a health risk assessment. This helps the member interpret their risk. We just want them to go in and get checked. And if they need to start taking a medication to control their diabetes, their hypertension, or the high cholesterol, great, go ahead and start doing that, right? And so if you do that, you get a gift card, a cash bonus, or a reduction in your premium. But a number of employers take the stance that, wait a minute, this guy doesn't want to go in and get checked, but he wants to be on our health insurance. If he's not willing to go see a doctor and he's engaging in all of these unhealthy behaviors, he actually is higher risk to our organization. Therefore, we should charge him more. And so we see a number of employers moving to the stick approach to, if you don't go and do these one or two basic things, you're going to pay a little bit more for your health insurance. And usually that is, it does one or two things. It either the employee says, I'm not paying more for my health insurance, I get off the plan, or the employee says, man, I got to go get a health risk or a preventative screening because I get a discount on my insurance if I don't, or I'm going to pay more if I don't. So we're trying to incentivize, again, the behavior that we want to see. So when it comes to wellness plans, our approach is start with the foundation, which is knowledge. And that knowledge comes from preventative care. And so we want to make sure employees understand, what's my risk? Do I have undiagnosed health conditions? Can I start treating those? This getting an established with a provider, whether you use the carrot or the stick approach. Now, if you're going to use the stick approach where you're going to charge a higher premium, there's a handful of compliance considerations that your advisor is going to want to take, namely, from an affordability standpoint, we want to make sure that your lowest cost plan is still compliant with the Affordable Care Act. And from there, you can build out a wellness program depending on how deep you want to get. But I hope both of these topics were helpful to you. If you're curious, the reasons I want to share all this knowledge with employers like you is because I don't have the capacity to work with everybody nationally, but I think about how big the problem is nationally in our society when it comes to the cost of healthcare and insurance. It's extracting so much value from your business. It's extracting value from your employees. Think of all the money they spend on healthcare and insurance. It's money that doesn't go to 401k, retirement, kids' college education, just everything that the American dream is built on is being taken. And there's a better way forward where we're able to offer more to our employees. And in many cases, we're able to waive costs, reduce insurance premiums, in some cases, make it no costs. Think about the impact that could have on your business. And so I want to share all of this information with you because I want you to be able to take it, whether it's with another advisor, somewhere in your business, and make an impact. You can't see it here, but I've got a dry erase board here with a number of scribbles and notes and whatever else. But across the very top, I have the number 1 million written across the top of my board. And that million represents the number of lives that I want to impact over the next decade with these sorts of programs and information. And I don't have the capability of impacting 1 million lives directly. It's going to come from working with other advisors and consultants, teaching them what we do, but also giving the information to you as an employer that you can impact in your business. We work with another number of vendors and carrier partners to help design programs that use a lot of the concepts and philosophies that we use. But my goal with this podcast is to give you information that you can take immediately and implement at your next renewal or in your business. Some of these things that I'm going to share with you, you don't have to wait until renewal. You can start doing some of these during the year. And so I hope this was helpful to you. If you're curious or you have other questions about what I talked about today, feel free to send me a note. I'm happy to share whatever information that I can to make this meaningful for you. My goal is to help you reduce your costs, increase your profitability, drive additional value, and help your employees as it relates to their health insurance and healthcare. So until next time.